All right, let's get over to Matt Graham. He is here live with us. Matt, good to have you here, friend. Appreciate you being here. What do you have for us today? I'm looking at this as not a good day for the markets, Matt. Not friendly.
Good day, week, month, year.
Yeah.
Yeah, things aren't good and things are getting frustrating for the average fan of rate commentary or bond market commentary because things aren't necessarily as logical as we might like them to be. And the cries of what the hell is causing this drama are running rampant right now. And it's both complex and simple at the same time. There are a couple complicated reasons, a couple simple reasons. But the reality is that, in a general sense, the bond market is undergoing a repricing. And we use the term repricing to refer to lender reprices on MBS Live, but then it also has that broader context of those moments in time where rates know they need to get somewhere and they're not going to be able to go there all at once. But as they make daily progress, maybe it's 2 steps forward, 1 step back, or 4 steps up and half a step down, we slowly but surely get to these levels unless acted upon by another force. Right now, those other forces aren't really doing much acting, so we're getting what we get in terms of this relentless pressure toward higher rates. So why is it happening? And it seems like a surprise to some people, and it certainly is. It's a surprise to many bond analysts, even, who expected to see 4.25 or 4.3% put up more of a fight in terms of 10-year yields and ceiling potential from a technical standpoint. But the reality is that that may have been the case. We may have seen some support there if it weren't for a confluence of a few factors that maybe were unexpected. And those include things that we talked about last week and continue to be problems this week: foreign central banks selling in Japan and China in order to defend currency valuations, and things that are really logical in the bigger picture and relative to what the Fed's been saying. It's simply economic data. We don't have new economic data today or even last Friday driving things, but we have fresh in our minds the retail sales report that was much higher than expected, other economic reports that continue to suggest the market just hasn't, or the economy just hasn't seen enough damage for the Fed to want to back down on its higher for longer policy. The other issue here is that the Fed is transmitting policy via the length of time that it's going to hold short-term rates at a ceiling. It might end up hiking if data were to get even stronger, but it doesn't necessarily need to hike anymore at this point. Powell has said that policy is restrictive, and so they're going to transmit that policy via the length of time that they hold rates at the ceiling. That means that as the market needs to adjust to fluctuations in the rate outlook, it has to do so primarily in the longer end of the yield curve. And that has made for this bear steepening that everybody's talking about recently. And all that means is that there's more volatility and more upward potential for longer term rates like 10-year yields and mortgages when econ data or other factors suggest that the bond market should do some selling. What changes this? It's going to take data. Some people were saying, hey, I thought we were data dependent. We didn't have any data last week, and now rates are going higher. So what's up with that? Rates are on a glacial pace in terms of momentum heading higher. And there's momentum behind that, right? Like a big glacier. And it's going to take new data to stop that. So it's a process that's in motion. That's what people need to understand. It's a process that's in motion. It's the path of least resistance right now, even though it seems to some people they might think it's stupid how high rates are going. But we need to have data that pushes back in the other direction to stop things, or some other event like the banking crisis or the mini banking crisis in March, where it looked like things might be breaking. Stuff like that can certainly push back in the other direction. But we need data, and we need maybe some clarity from Powell on this new debate on R star, or the neutral rate of return, the rate that the Fed thinks will create a perfect homeostasis between growth and inflation at sustainable levels. And there's been talk recently about that theoretical rate moving higher. And by talk among the journalistic and analytical communities, not amongst Fed themselves, because they've said there is not talk of that. And if Powell were to reinforce that this Friday at Jackson Hole, that might be a little bit helpful. And if he were to reinforce the inflation target, that I don't know if that would hurt or help, but in any event, the market would like clarity on that. I think it might actually hurt if he reinforced that, but who knows at this point. We need the data. We need people to start losing their jobs and things to be bad. You know what I mean?
It's a sick world we live in, the mortgage side. We want to have, in order to get better rates, we got to have bad news and people going through difficulties. And that's that going on. But it's interesting, the data, there's no data, and we're still having rates rising. And you raise a really good point on that. Very curious.
Yep. Yeah, definitely that the glacier is moving.
The glacier is moving. We got Les Parker dialed in here. So Les, if you could come on, love to get your perspective. Good to have you joining in, Les.
I don't know how much perspective I have, but I have a question for Matt. I would like to know, what's the liquidity looking like in sevens and even 7.5s?
Oh, very poor. I heard 7.5s for 4 trades on Thursday or something like that. So 7's a little bit better. I don't have exact numbers for you, but just the same way it was when we were on the way up at lower rates. These frontier coupons are slow to thaw, but we can divine their prices by extrapolating them from 6.5s and 6s. And that's, I think, more of what's going on right now, although I think 7s are rapidly needing to get more liquid based on the rates that are going out the door.
There certainly seems to be market consensus that if I buy a 7 with any premium, that premium is going to disappear.
Yep.
So that's one reason why it's constrained. What do you think about, you mentioned Powell speaking Friday. I know I've gotten a number of different mortgage bankers asking, what's happening with Jay's speech? Will this move the market? Well, the Fed's policy, I think, is set in stone. Yeah. There's really not going to be any change in that. The only thing data can maybe shrink this long-term extension. Doesn't that kind of imply that this will be a non-event on Friday? What do you think?
Yeah, I'm more in the non-event camp. And I like to always put out a disclaimer that you never know if the Fed or Powell at a speech might say something that the market takes and runs with it. But I think my baseline is that what can he say that hasn't already been said in the most recent press conference and other Fed communications? I think it's been pretty clear.
Yeah, I think the market is absolutely subject to liquidity events. And I think we could have some liquidity events, not just in the United States, but in China and maybe other places. Obviously, you've commented a few times on the property developers in China. They still are having issues. And even today, the Wall Street Journal came out with, I think it was Wall Street Journal, may have been the Financial Times, I don't remember. But they were coming out with that China's in a difficult situation. It was Financial Times. And their situation is, these are neo-Keynesians that I'm reading. So they think China must start to stimulate its economy. Otherwise, it's not going to get out of this and will continue to be a drag on the global economy. And of course, it could be sending out deflation to the world. Do you have any thoughts or reflections on that?
None that are educated enough to matter to anybody. I'm not really an expert on that, and maybe a little bit of a default sort of skeptic when it comes to China as a driver of big picture change for U.S. rates. I know that to the global economy, it's consequential. And then I think to the U.S. economy, people think that there's maybe more of a correlation than there is when it comes to a slower, weaker China causing a slowdown in the U.S. economy. I do think, as you said, it is more likely that it helps to cause deflation via exports. But then the question comes up of how much have we done? Have we really done? And I have no idea when I asked this question, but how much have we really done in the last 2 years in the onshoring movement to bring manufacturing either back home or away from China, given the supply chain issues that cropped up after COVID?
My last comment, and then I will have to sign off, Dave, is concerning locks. I know that mortgage bankers are talking, and loan officers for that matter, but it's more happening at the cap markets area. They're wondering whether the new apps that are coming in, these apps are floating, they are not locking in, and they look at it, their pipeline is full of phantom loans. Not that they're not real, they really are applications. However, will they actually become a closing if they don't lock?
Right.
So that's what I think there is a major concern there. It's by the way, it happened before in the market in recent times in 2019, the second half of 2019, early 2017 was we had this rapid run up in rates, and they were just getting apps, but they didn't actually materialize into closing. So a lot of phantom pipeline. David may even want to chime in on that, Dave, when have a chance, but I have to sign off. I'll listen to what you guys have to say. Thank you.
Yeah, thanks for joining us. Yeah, really appreciate that. I'd like to get the rest of the participants on the podcast jumping in on this. Mark, David Kittle joining in, Alice joining in on this, Alan. When you look at where rates are at right now, I'm really looking at a lot of the predictions, unless if there's less already. I think he already jumped out. Oh, no, you're still here, Les. If you could just quickly comment about the prediction of the rates falling this year. That has come up a lot. Several clients' calls I had earlier this week.
I can give you a quick, real quick on that. Right now, we're in a bear market.
We're in a bear market.
So until we change that, you can't be too bullish. However, my 6-month outlook, I see significant drop in rates. Obviously, UWM also thinks that, since they're staffing up to be able to hit this mini refi boom that might be, and that also is creating the problem with trying to get liquidity in 7s and 7.5. So you're in the industry itself is creating some interesting dynamics going on. Additionally, what we see is mortgage companies are thinking, oh, they're holding on to way too many employees. We're only off on the employment by, call it 20%. Maybe I think it's around 20%. And yet production's off 50%. Oh, right. That's a huge gap. I still see this big bull market coming for going into the end of the year, maybe into the first quarter, but that's because I see a recession coming, and I also see liquidity crisis in the banking system in the United States, and I see other liquidity crisis happening in Europe, and I think China is going to be exporting more deflation. That's my reasoning, but we are in a bear market. So until it really changes the technicals, and as Matt and I both we're a good duet right now, we need data, and we just don't have enough data right now. The little tiny signs show that inflation is easing, but you need more than that. And then there's others that really look at employment data. You want to talk about a lagging indicator. Almost every dimension of employment's lagging indicators. So I don't see how rates increase significantly from the levels we're at, 25 beeps or so. Okay. But I do see more of a risk for a significant drop in rates.
And the BRICS nations, if they release a currency, if they in fact do that, I don't know exactly where that's at, but I know something's coming up here pretty quickly on the BRICS nations on the recent.
I don't see it yet in the indexes for the emerging markets and how the dollar trades against those. And I also don't see it in the dollar index against the major indicators. That is, as I've put in my newsletter the last few years on my annual forecast, that is the big issue. The single biggest issue facing monetary policy, fiscal policy, and for a subset, mortgage rates is, does the US dollar remain the reserve currency? It is still the reserve currency. It needs to be dropped by about, if you consider its level around 60%, it needs to get down below 50 and approaching 40% of all transactions globally. If you get in that area, rates in the United States, is everyone sitting down, will significantly rise, because it is us being the reserve currency, and an irresponsible reserve currency by that, because of our fiscal policy. Because of that, we are getting significant subsidies in our rates. when we no longer are the reserve currency, but one of, then rates will be significantly higher in the United States. So a mortgage rate of 7 is going to look really attractive because we'll probably be in the 9s.
Wow. That is interesting. I know that's getting a lot of attention on a lot of the podcasts of financial networks. Les Parker, thanks for sticking around a little longer than you probably would like to have. I'll let you go on to your call. Appreciate it. Matt, any final thoughts on what he was talking about? Les.
No, it's hard to argue with pretty much all that. I think you did a great job.
Yeah, good job. Matt Graham, thank you so much for being here. If you want to sign up for Matt Graham's amazing MBS Live system, go to mbslive.net and go there and you put in the code LOL when signing up. You'll get an extended trial period without the need of a credit card. But come on, this is so affordable and it's so critical that you have this tool and have this information on your screen and all your devices. I leave, go lunch. I take it with my iPad. I have it on my iPad. I take a look at what's going on my iPhone, no matter where I'm at. I have this up. I go to a meeting offsite, go to a lot of board meetings. I have this on my iPad. It is just such a powerful tool and you need it. Get signed up. You can do the trial code if you want, but just get signed up. So good. Matt, good. Thank you for being here. Appreciate you so much.
You bet.